show you is one of the highest win rate strategies you can possibly do in trading. It is very easy to use, works in almost every single market, and most importantly, it makes money. Well, enough talk, let's get straight into it. The MACD, or the moving average convergence divergence, is one of the most popular technical indicators used by traders. Essentially, this indicator uses moving averages to find trends in the market, and it's pretty damn good at it too. Now, if you're an experienced trader, you've probably used or heard about this MACD indicator before, but the MACD indicator by itself is just alright, to be honest. So make sure you watch this full video to see how I pair it with some other indicators to make it perform so much better. First things first, let's add the MACD indicator to our chart. To do that, you're going to go to TradingView or whatever chart website you prefer, and then you're going to go up here to the Indicators tab, type in MACD, and click this top one. Now that we have the MACD indicator added, let's make sure we know how the MACD actually works. The MACD is made up of 4 different components: the MACD line, the signal line, the histogram, and the zero line. The MACD line, which is the blue line, in most cases is usually a 12-day moving average. The signal line, which is the orange line, is usually a 26-day moving average. Next, we have the histogram, which represents the difference between the MACD line and the signal line. So, for example, the smaller the space between the two lines, the smaller the histogram gets. The bigger the space, the bigger it gets. You can also see once the MACD line crosses above the signal line, the histogram turns green, and if the MACD line crosses below the signal line, it turns red. And finally, we have the zero line, which basically represents the center of the MACD indicator. Now that we know the 4 components, let's make sure we know how to use them. The MACD indicator is insanely good at finding trends in markets. How you can tell if a chart is about to have an upward trend is by looking for a cross upwards between the MACD line and the signal line. For example, here the MACD crosses above the signal line, indicating the chart is in an upward momentum. And here the MACD crosses below the signal line, indicating it's in a downward momentum. You can also use the histogram to indicate how much momentum there actually is. So if the histogram is getting bigger, that means there is an increase in momentum. If it's getting smaller, there's a decrease in momentum. So how you actually want to use this indicator is by when the line crosses upwards, but only if they cross below the zero line. If they cross and it's above the zero line, you wouldn't want to enter the trade. It's the same concept with shorting. You only want to enter a short trade if the lines are crossing downward and it's above the zero line. So as you can see just by watching this indicator is extremely easy to use. But the problem most traders encounter is that they only use this indicator by itself. Let me tell you why this doesn't work. The MACD indicator works extremely well if the market is in a trend. So for example here, the MACD indicator is doing a great job indicating when the price is about to move upward because the chart is in an upward trend. But here the price is in a downward trend, but the MACD is still signaling to buy long even though the price is going down. A simple fix to this issue, for example, if we're trading long, we only want to trade if the market is in an uptrend. You never want to trade against the trend because the odds will always be against you. So an easy way to figure out if the market is in an uptrend, you simply just need to add a 200-day moving average. To do this, you're going to go to the Indicators tab on TradingView and type in EMA, which stands for Exponential Moving Average or Moving Average Exponential. Click the top one. Then you're going to go here, click the settings of the EMA, and you're going to go to Inputs and change the length to 200, which is going to make it a 200 exponential moving average. Then you're going to go to Style, and I like to make mine red, but you can make it whatever color you want. Once we have the EMA indicator added, you'll see just a single line. If the price is above that line, the market is in an uptrend. If the price is below that line, the market is in a downtrend. So after learning that we only want to trade in an uptrend market if we're going long, so all we have to do is put it all together. We buy if the MACD line crosses below the zero line mark and the current price also is above the 200-day moving average. This will guarantee that you are only trading when the market is in an uptrend, which is a very powerful combo. If you wanted to short, you would do the exact opposite. So make sure the price is below the 200-day moving average and the MACD lines are crossing downward above the zero line. So as an example, we would want to enter a long trade right here because the MACD lines are crossing upwards below the zero line and the current price is above the 200-day moving average. Now what I like to do is set a stop loss below below the 200-day moving average. So the 200-day almost acts as a wall that the price has to break through to hit the stop loss. Then I like to have a 1.5 profit ratio for my profit target mark. So as you can see for this example, the strategy worked exactly as we wanted it to, and we made money. But we can still make this trading strategy even better. This MACD strategy combined with a 200-day moving average works extremely well only if there's a lot of price movement. Where the strategy starts to get kind of iffy and giving false signals is when the chart starts going sideways and losing momentum. So as you can see here, the chart is moving sideways and lost almost all of its upward momentum, and the MACD is giving lots of false signals. If you traded here, odds are you probably lost money. To fix this issue, we have to combine the MACD with price action. To do this, identify a key support or resistance where the price hits and bounces. So as you can see, the price goes down, hits this point, and reverses upwards. The next step is to wait for that price to hit the same key level again, and once it does, we are expecting the price to bounce off the support and go upwards just like it did before. But as a clear side note, just because we made this support and it bounced off this before doesn't mean that it'll always do it again. It can easily break through the support and drop lower if it has enough momentum. If we want to make sure the price is about to change in momentum, that's when we bring out the MACD indicator. So what you would do is make sure the price is above the 200-day moving average. Once the price hits the support made, wait for the lines on the MACD to cross below the 0 level, and that's when you enter the trade. I just revealed to you how the MACD 200-day moving average and using support and resistance levels gives an extremely high win rate with this strategy. All I ask in return is if you can take 2 seconds of your time and like this video. If you want to stay up to date with my future strategies, make sure to subscribe, because in my next video I'm planning to release a strategy that works even better than this MACD strategy. Hope you guys all learned something from this video, and I'll see you guys next time.